Hi everybody, welcome back to Chapter 19. In this video, we'll work through an illustration of accounting for the grant of restricted stock units. Keep in mind that the major difference between a restricted stock award and restricted stock unit plan is that in the award plan, the shares are issued at the date of grant, whereas under the restricted stock unit plan, the shares are not issued until the vesting period ends, for restrictions are lifted, and then the stock is issued. However, the accounting for both plans is very, very similar. This is illustration 19-2 in your textbook. Under its restricted stock unit plan, RSU, Universal Communications grants RSUs of 5 million shares of its $1 par value common stock to certain key executives at January 1st, 2021. The shares are subject to forfeiture if employment is terminated within 4 years. Shares have a current market price of $12 per share. On January 1st, 2021, the date of the grant, there is no journal entry necessary. However, we do need to calculate the total compensation expense. 5 million shares were included in the award. They had a $12 per share market value at the date of grant. $12 per share times 5 million shares equals $60 million of total compensation. Remember, however, that we account for the compensation expense in the years in which services are performed. If $60 million in compensation is to be awarded over 4 years, then we will recognize $15 million of compensation expense per year. The journal entry is made in each of the 4 years as a debit to compensation expense, $15 million, and paid in capital - restricted stock, $15 million. I think you can see that after this journal entry is made 4 times, at December 31st, 2021, 22, 23, and 24, we will have accumulated $60 million in the paid-in capital - restricted stock account, which is an equity account. Once the stock award vests after the 4 years of service, the shares of stock are issued and the paid-in capital account - restricted stock is eliminated by debiting the account for the $60 million accumulated over the 4-year period. Debit paid-in capital - restricted stock, $60 million, removes that account from the books. Now let's talk about these numbers. Looking at the original transaction is a reminder that 5 million shares were included in the grant, and those shares were of $1 par value common stock. So when the restrictions are lifted and the shares vest and the actual shares themselves are issued, we're going to want to credit common stock by $5 million. That's 5 million shares times $1 par value per share. If the market price of the stock at the date of grant was $12 per share, $1 of which is credited to the common stock account, that leaves $11 per share to be credited to the paid-in capital account. 11 times 5 million shares is $55 million of paid-in capital in excess of par. And that's where these numbers came from. So the journal entry at the date when the restrictions are lifted and the actual stock itself is issued, we debit paid-in capital restricted stock, $60 million, to get it off the books. We credit common stock, $5 million, and credit paid-in capital in excess of par, $55 million. Now let's work a couple of concept check problems relating to RSUs. Zarshena's Jewelers granted restricted stock units, RSUs, representing 120 million shares of its dollar par value common stock to executives, subject to forfeiture if employment is terminated within 4 years. After the recipients of the RSUs satisfy the vesting requirements, the 4 years, the company will distribute the shares. The common shares had a market price of $5 per share on the grant date. What is the total compensation cost pertaining to the restricted stock units? Is it A, $15 million, or B, $120 million, or C, $150 million, or D, $600 million? Please pause the video to prepare your calculations and choose your answer. Then start the video again to check your work. The correct answer is D. We have 120 million shares times $5 per share market price equals total compensation of $600 million. Of course, that $600 million of total compensation will be recognized as expense over the 4-year vesting period. Here's another problem for you. Garavelli Industries granted restricted stock units, RSUs, of 60 million shares of its $1 par value common stock to executives, subject to forfeiture if employment is terminated within 3 years. After recipients of the RSUs satisfy the vesting requirement, the company will distribute the shares. The common shares had a market price of $8 per share on the grant date. Ignoring taxes, what is the effect on earnings in the year after the shares are granted to the executives? Is it A, 0, B, $60 million, C, $160 million, or D, $480 million? Again, please pause the video, prepare your calculations, and choose your answer. Then start the video again to check your work. The correct answer is C. There were 60 million shares in the grant times $8 fair value per share equals $480 million of total compensation divided by the 3 years in the vesting period equals $160 million of compensation expense per year. Well, that's all for this video. In the next video, we'll begin a discussion of stock option plans. See you next time.